What if a single decision made by just a handful of people could kick off the most explosive move in Bitcoin's history? It might sound like a stretch, but it's not fiction. The Federal Reserve, the central bank of the United States, is backed into a corner. After aggressively raising interest rates to fight inflation, the economic and political pressure is becoming too much to bear. A rate cut is no longer a question of if, but when. Recent statements from Fed Chair Jerome Powell have all but confirmed this, citing rising downside risks to employment and the need to prioritize growth. In this video, we're not just going to tell you that rate cuts are good for Bitcoin. You've probably heard that before. We're going much deeper, revealing the powerful, almost mechanical link between central bank policy and Bitcoin's price. We'll unpack the data showing why the next series of rate cuts could ignite a historic rally, what the market has dubbed a Bitcoin God candle. We'll break down the trap central banks are in, explore the mechanics of the liquidity tsunami they're about to unleash, and show you with hard evidence why Bitcoin is uniquely positioned to absorb that capital. Finally, we'll look at how you can prepare for what might be coming. This isn't just another crypto video. This is a macro masterclass that could change how you see the financial world. Before we get to the solution, you need a crystal clear understanding of the problem, and that problem is financial repression. It sounds complex, but the idea is brutally simple. It's the set of policies governments and central banks use to manage massive amounts of debt. It's a subtle, slow motion transfer of wealth from savers to debtors, and the government is the biggest debtor of all. Think of it as a silent tax. It's not a law you can vote against. It's done through monetary policy. The main tool is keeping interest rates below the real rate of inflation. When the interest you earn in a bank or on a safe government bond is lower than the rate your money is losing purchasing power, you're being repressed. You are guaranteed to lose money in real terms. You're literally paying for the government's debt without ever writing a check. Here's an analogy. Imagine you're a frog in a pot of water. If someone dropped you into boiling water, you'd jump out immediately. But if they put you in lukewarm water and slowly turn up the heat, you might not notice the danger until it's too late. Financial repression is that slowly boiling water. Each year, your dollar buys a little less. Your salary, even with a raise, doesn't stretch as far. The goalposts for a comfortable retirement keep moving. That feeling of running faster just to stay in the same place, it's not a personal failure, it's a feature of the system. The game is rigged against the saver. Why do they do this? Because they don't have another choice. Government debt around the world, especially in the US, has hit astronomical levels. That debt has to be serviced. When interest rates are high, the cost of paying the interest on that mountain of debt becomes crippling, eating up the national budget. So, the only politically acceptable option is to inflate the debt away. By debasing the currency, they make the debt smaller in real terms over time. It's a slow, invisible default that most people don't understand. This is the cornerstone of the modern financial system. But this constant pressure forces savers to take on more risk just to preserve their wealth, pushing them away from traditional savings and into assets that can't be so easily debased. This is the stage for our entire story. The plot is inescapable financial repression, and it's why an asset like Bitcoin isn't just an interesting technology, but a profound necessity. Now that we understand the long-term game of financial repression, let's zoom in on the situation the Federal Reserve faces right now in late 2025. They're caught between a rock and a hard place with no good options. Every path leads to a different kind of disaster, and they have to choose the lesser of two evils. On one hand, they could keep interest rates high. This is the hawkish stance they took to fight the inflation their own policies created. The textbook theory says high rates cool down the economy and bring prices under control. But in an economy built on decades of cheap debt, that medicine is a potent poison. Prolonged high rates wouldn't just cool the economy, they'd freeze it solid. It would trigger a severe recession, the housing market would seize up, corporate profits would plummet, leading to layoffs and soaring unemployment. We're already seeing the first signs, with a weaker job market being a key reason the Fed is changing its tune. Most critically, high rates make the government's own debt payments spiral out of control. The system is simply too fragile and indebted to handle high interest rates for long. On the other hand, they can cut interest rates. This is the pivot the market has been anticipating for months. It's the path of least resistance. Cutting rates provides immediate relief by lowering borrowing costs, stimulating investment, and making government debt manageable. It's the economic painkiller. But this choice is also dangerous. Cutting rates signals that the fight against inflation is over, not because it was won, but because fighting it became too costly. It's an admission that they'll accept higher inflation to avoid a deep recession. This unleashes currency debasement. It tells every saver and every nation holding US dollars that their money will be deliberately eroded. It's a return to the same easy money policies that caused the inflation problem in the first place. So, what will they choose? History is pretty clear. When faced with a choice between a deflationary collapse, recession and debt crisis, and an inflationary expansion, devaluing the currency, central banks always choose to print. They will always choose inflation. The political fallout from mass unemployment is far more terrifying to them than the slow tax of inflation. This is why the rate cut is inevitable. The Fed already delivered a 25 basis point cut in September 2025, its first major policy shift in a while. Projections from major banks like JP Morgan suggest more cuts are coming, with expectations for at least two more in 2025 and others to follow in 2026. They're trapped. They have no other move. They have to cut, and in doing so, they're about to open the floodgates. We've established that a rate cut is coming. Now, why is this single action so powerful? The answer is liquidity. A central bank rate cut is the master switch that floods the global financial system with liquidity. Think of the global financial system as a single, massive ocean. The assets, stocks, bonds, real estate, crypto are all boats. Global liquidity is the tide. When the tide comes in, liquidity expands and all boats rise. When it goes out, they fall. Technically, global liquidity is the total money available, often measured by the M2 money supply of major economies. M2 includes cash, deposits, and other easily convertible assets. A chart of the global M2 money supply over the past few decades shows a staggering, almost uninterrupted climb. By late 2025, this figure is already sitting near $96 trillion and is on an upward trend. Rate cuts are the main way to bring the tide in. When the Fed cuts rates, it's cheaper for banks to borrow, so they lend more. More loans create more deposits, and the money supply grows. That new money has to go somewhere. It flows out of low-yielding savings accounts and into riskier assets with higher potential returns. This fuels bull markets. This isn't a theory. The data is clear. Analyses have shown a stunningly strong positive long-term correlation between global liquidity, M2, and Bitcoin's price. The correlation has been measured as high as 0.94, meaning when global liquidity goes up, Bitcoin's price has historically followed in a highly predictable way. But here's a crucial detail most people miss: the lag effect. The impact isn't instant. It takes time for that new liquidity to work its way through the system. Studies show a typical lag of about 56 to 60 days, roughly 2 months, between a monetary expansion and a visible response in Bitcoin's price. This is a critical piece of the puzzle. It means when the Fed cuts rates, the starting gun is fired, but the race doesn't really begin for another couple of months. Smart money knows this and positions itself accordingly. So when we say the Fed is about to cut rates, what we're really saying is that they're about to turn a spigot that will unleash a tidal wave of new money. Now let's explore why Bitcoin is the vessel perfectly designed to ride that wave. So, we've laid out the inescapable problem of financial repression and the corner the Fed has painted itself into. We're now connecting the dots, showing how their next move is set to flood the system with new liquidity. The data shows this liquidity is the primary fuel for Bitcoin's bull markets. If you're finding this analysis valuable, and if you want to stay ahead of these powerful macro shifts, take a second to subscribe to our newsletter. It's where we share our most timely insights, often before they make it into a full video. The link is in the description. It's free, no spam, and it's the best way to ensure you don't miss the starting gun. Now let's get back to the most important part: why Bitcoin is poised to capture this coming tidal wave of money unlike any other asset. We've seen the fuel, a coming tsunami of global liquidity, but why does that fuel get channeled so aggressively into Bitcoin? Why doesn't it all just go into stocks or real estate? The answer lies in Bitcoin's unique properties, which make it what many analysts now call the ultimate liquidity barometer. It's the purest expression of monetary expansion in the world. Let's break down why Bitcoin is so different. First, Bitcoin is a pure macro instrument because it has no traditional cash flows. A stock's price is tied to earnings, profit margins, and the economy's health. Real estate is tied to rental yields and local conditions. Bitcoin has none of this. It doesn't pay a dividend or have a CEO. Its price isn't tied to any single company's performance. This makes its price an incredibly clean signal. It's driven almost entirely by two things: its fixed supply and the amount of money flowing into it. It purely reflects the ebb and flow of global money. Second, Bitcoin is a truly global, decentralized asset. A Fed rate cut doesn't just affect the US, it sends ripples worldwide. Bitcoin isn't anchored to any nation state. It trades 24/7 in every country. It's a global escape valve for anyone seeking to preserve their wealth from currency debasement. When liquidity expands globally, Bitcoin is there to absorb it from every corner of the planet. Third, and this is the killer feature, Bitcoin has a perfectly inelastic fixed supply. While central banks can create currency out of thin air, Bitcoin's supply is forever capped at 21 million. Its issuance schedule is written in code and can't be changed. This creates a powerful dynamic, an expanding ocean of fiat currency crashing against an unmovable island of absolute scarcity. When a potentially infinite amount of money chases a strictly finite number of units, the price is the only thing that can adjust, and it must adjust upwards. This is the lifeboat analogy in its purest form. The traditional financial system is the sinking ship. Central bankers, trying to keep it afloat, are pumping in more water. Liquidity. Savers are drowning. Bitcoin is the digital lifeboat with a fixed number of seats. The price of a seat is just a reflection of how desperately people want off the sinking ship. Let's compare this to other assets. Stocks are a flawed hedge, still tied to a struggling economy. Gold is the traditional lifeboat and also has a high correlation to liquidity, but Bitcoin's correlation is even stronger, and more importantly, its directional alignment is remarkably consistent. Over 12-month periods, Bitcoin's price has historically moved in the same direction as global liquidity a great majority of the time, a rate that other major assets have struggled to match. Gold is the analog lifeboat, heavy and hard to move. Bitcoin is the digital, weightless lifeboat accessible to anyone with an internet connection. This is what creates the potential for a God candle, a single massive green candle on a price chart representing a violent repricing of an asset. It happens when a flood of new demand, fueled by a macro catalyst like a liquidity injection, collides with an asset that has a fixed supply. The next series of rate cuts is precisely that type of catalyst. This thesis isn't just a theory, it's a reality already starting to take shape. If you know where to look, the pieces are falling into place. First, the liquidity itself. Even before the next big round of cuts, global M2 money supply is near all-time highs. Plus, many central banks outside the US have already started easing. The European Central Bank, for instance, already cut rates in June 2025, creating a global tailwind for asset prices. Bitcoin's price has already shown its sensitivity to these conditions. Second, look at investor sentiment. Current market sentiment is only slightly above average, a far cry from the widespread euphoria that marks major market tops. This suggests there's still significant room for growth. The big money hasn't fully rotated in yet. Third, and perhaps most importantly, the pipes to channel new liquidity into Bitcoin are more robust than ever. The approval of spot Bitcoin ETFs in the US and elsewhere has created a regulated on-ramp for institutional capital. These ETFs are the superhighways connecting the trillions of dollars in the traditional financial world directly to Bitcoin. When wealth managers and pension funds decide to allocate even a tiny fraction of their portfolios to hedge against currency debasement, these ETFs will be the primary vehicle. They are ready to carry the coming liquidity wave. So, we see a macro environment screaming for easing, central banks starting to pivot, and an institutional infrastructure ready to absorb unprecedented capital. People who say the move is already priced in may be underestimating the sheer scale of the monetary shift that's coming. The market's choppy reaction to the September rate cut is exactly the kind of environment where an underlying trend builds quietly before a major breakout. Now, let's ground ourselves in reality. A strong macro thesis doesn't mean we ignore the risks. The path to a new all-time high will be volatile. First, while the long-term correlation between liquidity and Bitcoin is strong, the short-term correlation is much weaker. In plain English, crypto-specific events like an exchange collapse or a regulatory crackdown can cause sharp, painful corrections, even if the macro trend is positive. These are the event-driven decouplings we've seen in the past. Second, we have to respect the lag. As we discussed, there's often a 2-month delay between a liquidity expansion and Bitcoin's price response. This means when the Fed announces its next cut, the market might not erupt overnight. A common pattern is a sell the news dip, where short-term traders take profits. Impatience is your greatest enemy here. Such a dip could be a buying opportunity before the real wave of capital arrives. Finally, there's always the risk the Fed's actions are different than expected. They could hold rates high for longer than anticipated, creating headwinds for all risk assets, including Bitcoin. However, framing these risks correctly is key. They aren't reasons to discard the thesis, they're reasons to have a long term time horizon, avoid excessive leverage, and understand that volatility is the price you pay for outsized returns. The long term trend, driven by the math of debt and the politics of currency debasement, remains overwhelmingly clear. Let's put it all together. We are living through a period of profound financial change. The system of ever expanding government debt has forced central banks into a corner where they must engage in financial repression, a slow but steady debasement of our money. Their problem has now reached its end game. The Federal Reserve is trapped. It can't hold rates high without crashing the economy, so it must cut. This inevitable action will act as the starting gun, unleashing a new wave of global liquidity. This wave of capital will seek a home where it can't be diluted. And the data shows, with remarkable clarity, that the asset best designed to capture this flow is Bitcoin. As a global decentralized instrument with an absolutely fixed supply, its price acts as the world's most sensitive liquidity barometer. The evidence is already mounting. Liquidity is high, institutional on-ramps are built, and central banks are signaling their next move. The next rate cut isn't just another data point, it's the catalyst. It is the spark that will ignite the fuel that has been accumulating for months. The Bitcoin God candle is not a fantasy. It is the logical, mathematical conclusion of a broken system meeting a perfect solution. It's not a matter of if, but when. So, what do you think? Are we on the verge of a liquidity-driven explosion for Bitcoin, or are there other factors that could change this outcome? I want to hear your perspective. Leave your thoughts and analysis in the comments section below. And if you want to stay on top of this story with in-depth analysis as it unfolds, make sure to hit that like button and subscribe to the channel. Your support helps us continue to bring you this kind of deep dive research completely free. Thank you for watching.